Flanders opening up the session that's about to take place, moderating a discussion between ECB President Mario Draghi, the Fed Chair Jerome Powell, Governor Kuroda of the Bank of Japan and the peer from the RBA. We can cross over now and take a listen, I think, to what President Mario Draghi's got to say.
Discussions today, but also last year. The first question is, there is clearly, well, the first point is there is clearly a variety of reasons why the response of inflation and wages has been so slow. And they go from measurement of the slack, low productivity, the trade unions have disappeared, structural reforms, labor supply has gone up, it's increased a lot. And then non-wage related aspects, like people wanting more stability rather than higher wages, especially because their employment is of low quality. And then the importance of past inflation. Now, to disentangle all these reasons, it's very difficult. But one conclusion is that we see that the combined effect of all these reasons is gradually washing out, is gradually waning. A good example is one given by the importance of past low inflation for a long time. The ECB staffs calculated that past low inflation has dragged about 0.2% out of wage growth in the last 3 years per year, 0.2% per year. And now we see that this effect is waning out, and as headline inflation is picking up, current headline inflation becomes more and more important, and past low inflation is losing importance. And so that's in a sense also says that anchoring inflation expectations was crucial and remains crucial, and fortunately they're well anchored. So once this is said, we see that nominal wages are indeed increasing. No matter which measure we take compensation per employee, we take compensation per hour, we take negotiated wages, all of them are going up. And they're going up around now, it's 1.9%, the last data point for the compensation per employee, and compensation per hour is the same, about the same thing. Well, having said that, is this going to be translated into higher inflation? Well, here I think the record is a little more mixed. For example, we had an increase in wage growth by 0.8% between 2016 and 2018 and this year, but the increase in inflation was only 0.1%, and because productivity gone up by 0.7%. Now, what do we expect for productivity? We do expect it will grow less than it has done in the late stage of the cycles, and wages, nominal wages, will grow more than they have done up to now. So all in all, we see the unit labor costs on an upward path. And by the way, the other consideration which was touched in the previous discussion was related to pricing power, the coming back of pricing power. And there, again, we see encouraging signs, because if we look at an index which more closely reflects input prices, namely the domestic non-food price inflation, in April that's gone up by 0.5%, which is the highest rate since, I think, the last 6-7 years. So all in all, this is encouraging. Now, what about e-commerce? Is this going to dampen this process of recovering inflation? And again, the previous discussion about whether an increase in concentration does affect the rate of inflation, to some extent gives some light on this issue. Now, the answer that we have is that we find very little evidence that e-commerce has any effect on inflation. It's clearly has increased price transparency, may have some compression of margins, some cost saving, but all in all, in the aggregate, this doesn't show into a permanent lower inflation. So probably the effects of the e-commerce and other aspects of globalization have to do more with the composition of industries rather than with an aggregate effect that we cannot find in the data, an aggregate permanent effect. So all this makes us confident that inflation is converging towards our objective, and we draw this confidence by the ever tighter labor market, by the high capacity utilization rates, and frankly, and as I will say in a moment, by the continuing ample monetary accommodation, also by the disappearance of what we call the tail risks of deflation. So all this has led the Governing Council last week to give guidance on monetary policy. And the first thing is we made, as I said last week at the press conference, we need to make sure that the ample degree of accommodation that is currently incorporated into the financing conditions on which the staff projections are predicated is maintained for as long as necessary in order to bring about the convergence of inflation towards our objective. And then we went through the various measures. We said that we intend to maintain our portfolio of accumulated securities for an extended period of time after the end of net purchases, and in any event as long as necessary. And then we enhanced our guidance on future rate path for our key interest rates. We said that we expect to hold them at the present level, at least through the summer of 2019, in any case for as long as necessary to ensure that inflation evolves along a trajectory that is aligned with the sustained adjustment path that we expect to see in the medium term. Thanks, Stephanie.
Thank you. Chairman Powell.
Thank you, Stephanie. Thank you, Mario. So 9 years into an expansion that has sometimes proceeded slowly, the U.S. economy is now performing very well. Growth is meaningfully above most estimates of its long-term trend, although admittedly that trend is not what we would have hoped it to be. The labor market is particularly robust, with unemployment at its lowest level since April 2000, and inflation has moved up close to our 2% objective, although we haven't yet seen it remain there on a sustained basis, as our goal would suggest we should do. Today, most Americans who want jobs can find them, and high demand for workers should support wage growth and labor force participation, the latter a measure on which the United States now lags most other advanced economies. A tight labor market may also lead businesses to invest more in technology and training, which should support productivity growth. And some groups, such as some racial and ethnic minorities that still have higher unemployment and lower participation rates, could also see increasing benefits from a tight labor market. In short, there's a lot to like about low unemployment. Achieving our statutory goal, though, of maximum employment in a context of price stability and financial stability is both our responsibility and our challenge. Earlier in the expansion, as the economy recovered, the need for highly accommodative monetary policy was clear. But with unemployment low and expected to decline further, inflation close to our objective, and the risks to the outlook balanced, the case for continued gradual increases in the federal funds rate is strong. I'll turn for a minute to current labor market conditions. At 3.8%, the unemployment rate is now below most estimates of its long-run level, which are clustered in the mid-4s. And many other labor market indicators also suggest an economy near full employment. And I'll name just a couple. One would be an elevated level of job vacancies. So for the first time since the labor market began collecting this data in 2000, there are now more job vacancies than there are people counted as unemployed. In addition, the quits rate is elevated, a sign that workers are able to find another job when they seek one. And surveys show that businesses are finding it difficult to fill vacancies and that households perceive jobs as plentiful. A couple of other indicators are less clear. Labor force participation among prime-age workers has moved up in recent years but remains below its pre-crisis levels. In addition, wage growth has been moderate, which is consistent with low productivity growth, but also an indication that the labor market is not excessively tight. Looking out ahead, the job market seems likely to strengthen further. Real GDP is now reported to have grown 2.75% over the past 4 quarters, well above estimates of its long-run trend. Expansionary fiscal policy is just arriving and expected to add to aggregate demand over the next few years. So many forecasters expect the unemployment rate to fall into the mid-3s and to remain there for an extended period. If that does come to pass, it will mean the lowest unemployment in the United States since the late 1960s, 50 years ago. Because we have so little experience with very low unemployment, it's interesting to compare today's labor market with that earlier period. Unemployment was below 4% from February 1966 through January 1970, and during that time, PCE inflation increased from below 2% in 1965 to about 5% in 1970. In hindsight, unemployment is now widely thought to have been unsustainably low and to have contributed to escalating inflation. But the question is, how significant and relevant is that precedent for today? The U.S. economy has changed in many ways over the last 50 years. By some estimates, the natural rate of unemployment is substantially lower now. For example, the Congressional Budget Office now estimates that the natural rate was about 5.75% then, and now a full percentage point lower. And rising education levels do point to a decline in the natural rate since the 1960s because more highly educated people are less likely to be unemployed. The share of the population with a college degree has risen from less than 15% to nearly 40% now, and the share with less than a high school degree has declined from 45% to about 5%. Another important difference from the 1960s is that inflation has been low and stable for an extended period, which has better anchored inflation expectations. Today, policymakers have a greater appreciation of the role expectations play in inflation dynamics and a clearer commitment to maintaining low and stable inflation. So, unfortunately, with the passage of a half-century and important changes in the structure of our economy and its central bank practices, in my view, the historical comparison does not shed as much light as we might have hoped. And that lack of useful historical precedent leaves us with some uncertainty about the answers to several important and challenging questions. First, estimates of the natural rate of unemployment by FOMC participants and others have drifted lower as unemployment has declined without much apparent reaction from inflation. But how reliable are these current estimates? They've always been uncertain, and they may be even more so now as inflation has become less responsive to unemployment. The anchoring of expectations is a welcome development, has likely played a role in the flattening of the Phillips curve, but a flatter Phillips curve makes it harder to assess whether movements in inflation reflect the cyclical position of the economy or other influences. Second question, what would be the consequences for inflation if employment were to run well below the natural rate for an extended period? The flat Phillips curve suggests that the implications for inflation might not be large, although a very tight labor market could lead to larger nonlinear effects. Research on that question is ambiguous, again, reflecting the limited historical experience. We should also remember that where inflation expectations are well anchored, it's likely because central banks have kept inflation under control. If central banks were instead to try to exploit the non-responsiveness of inflation to low unemployment and push resource utilization significantly and persistently past sustainable levels, the public might begin to question whether our commitment to low inflation continues, and expectations could come under upward pressure. Of course, so far we see no signs of this at all. If anything, some measures of longer-term inflation expectations in the United States have edged lower in recent years. Third question, can persistently strong economic conditions pose financial stability risks? Of course, strong economic conditions are a good thing. Such conditions can make the financial system better able to absorb shocks through strong balance sheets and investor confidence. But we've often seen confidence turn into overconfidence and lead to excessive borrowing and risk-taking, leaving the financial system more vulnerable. Indeed, the fact that the two most recent U.S. recessions stemmed principally from financial imbalances and not from high inflation highlights the importance of closely monitoring financial conditions. Today, I see U.S. financial stability vulnerabilities as in line with their long-run averages. While some asset prices are high by historical standards, I don't see broad signs of excessive borrowing or leverage. In addition, banks have far greater levels of capital and liquidity than before the crisis. Fourth, while persistently strong economic conditions can pose risks to inflation and perhaps financial stability, we can also ask whether there may be lasting benefits. As I mentioned at the beginning, a tight labor market could draw more people into the labor force. In fact, as the labor market has tightened, more workers have been moving back to work and off disability rolls. There could also be benefits to productivity and potential growth. All told, though, the persistence of any such positive hysteresis benefits is uncertain, since, again, the historical evidence is sparse and inconclusive. So to wrap up, as is often the case, in the current environment, significant uncertainty attends the process of monetary policy. So today, with the economy strong and risks to the outlook balanced, the case for continued gradual increases in the federal funds rate remains strong and is broadly supported among FOMC participants. Thanks very much.
Philip Lowe.
Thanks very much, Stephanie. It's a great honour for me to be able to participate in this panel. In some ways, I'm the odd one out here. I come from a small economy, not a larger one. We've had positive interest rates for the last decade. We haven't had to go anywhere near zero. We haven't done quantitative easing. We haven't embraced forward guidance. We've had 27 years without a technical recession. I'm hoping we can extend that a while longer. So, as I said, an odd one out. But I don't really feel like the odd one out, though, because the issues we're discussing here in Sintra are really at the core of the issues we're discussing in Sydney. In Australia, the inflation rate has been below the midpoint of our target for some years, and it's going to stay that way, I think. Wage growth has repeatedly surprised on the downside, and the current rate of wage growth isn't consistent with us achieving our inflation target on a sustained basis. So, like others, we're grappling with why we find ourselves in this situation. The fact that it's happening in so many countries suggests to me that there are global factors at work, and they're probably structural in nature. And the result of those factors is that the inflation process looks very different in many countries, and at the heart of that, I think, is the wage process, which looks different. Whether that's going to be permanent, it's hard to tell, but it's certainly persistent enough that it's important for policy. So what I'd like to do in my time is to offer some reflections on two issues that are really at the heart of this conference, and that is, why is the wage process different, and how much of it's structural, and what are the policy implications of that? So the wage process, as I said, is different. So the relationship between wages and unemployment looks to have changed. And there are three sets of factors that I think are really important here. One is the changes in the industrial relations landscape, and we saw a really good example of that this morning in Professor Schoenberg's paper. I think the evidence there is pretty compelling. Changes in industrial relations arrangements in Germany have affected wage and employment outcomes, and the Australian experience is very similar to the German one. It's hard to escape the conclusion that changes in industrial relations has changed the inflation process. The second factor, I think this is actually more important, that there's increased perceptions of competition arising out of globalization and technology. Everyone feels like there's more competition. And one of the first things you learn in economics is that there's more competition, prices aren't as high. We discussed this in the earlier session. And there are a couple of factors that are driving this extra perceptions of competition. One is globalization. There's hundreds of millions of extra people have entered the global labour force, particularly in China and India. And first of all, that affected manufacturing wages around the world, and now I see it affecting services wages. Many more services sectors are becoming tradable. I see a lot of examples where business services that used to be supplied in Sydney are now supplied in Manila or Chengdu or Bangalore. And that's meaning that everyone feels like there's more competition. And the other factor that's adding to the sense of competition is the nature of technological progress. It's much more likely to be embedded in intellectual capital and physical capital. And we're also seeing widening gaps between the leading firms and the laggard firms, and both of those features are affecting the wage dynamics. With technology progressing so quickly, and particularly for the leading firms, many firms are having trouble keeping up. They're having trouble adopting the new technologies, and to remain competitive, they focus on what they can control, and that is their costs. And the main cost they can control is their labour costs. So that the technology progress is leading for many firms to have a very, very strong mindset on controlling costs. Again, I see lots of examples of this in Australia. Almost every business meeting I go to, business people complain that it's incredibly hard to find workers. And I rather naively ask, well, why don't you pay more? Attract some workers from another firm. And when I do that, they look at me as if I'm completely mad. That'd be the last thing they would do. And I typically get a lecture about how competitive the world is. There's kind of competition from China, Japan, and they worry about kind of technology. And so the last thing I can do is increase my costs. It's the one variable I can control. So there's this very strong mindset that I've got to control costs, and I think it's coming from competition. It's a global factor, and it's structural. The third factor that's affecting the relationship between wages and unemployment is that labour supply in many countries is turning out to be much more flexible, and we're seeing this in a rise in the participation rate. There are a variety of reasons for this. One is, and we see this again in Australia, rising labour force participation by older people as health outcomes have improved. We've seen big advances in the health outcomes for many people, and our bodies are lasting longer as we're working in services rather than manufacturing, and that's allowing people to stay in the labour force longer, particularly when there are jobs there. I think that's quite an important factor, and the increasing acceptability of part-time employment is allowing many women particularly to stay in the labour force longer. So the labour supply is turning out to be quite flexible. So even though we're seeing very strong employment growth in a lot of countries, it's not translating into higher wages. So things look different. Industrial relations, increased perceptions of competition, and increased labour supply. And I think those factors are going to be around for a long time. So I don't expect the situation that we're dealing with to change quickly. So what are the policy implications of this? The main one, to me, is that the system that we're operating in looks less inflation-prone than it once was. And that's reflected in most of us worrying about inflation being too low, not too high. It's a very different world when I was at university. So listening to the discussion over the past 2 days, I've been trying to think about, or trying to listen for ideas about how we deal with this world that is less inflation-prone. And I can take the liberty of summarising the things I've heard under three broad kind of approaches one could adopt here. One is that central banks should just try harder. The basic conception of how the economy is working is fine. We just need lots of monetary stimulus. We need to keep at that. We need to just try harder, and eventually it'll turn out okay. The second perspective, a couple of people touched on this yesterday, is we just need to accept that inflation will be low for a while. After all, low inflation isn't that bad. Now, central banks want to achieve their inflation targets, that's clear. But most people out there in the communities that we're supposed to be serving don't really care that much if inflation's a bit lower than the target, especially if the labour market outcomes are okay, if there are plenty of jobs being created. So the second perspective is, well, it's not kind of fantastic, but we've just got to be patient, accept that inflation's going to be low for a while, and there's not really a great loss of social welfare from that. The third perspective was one introduced by Yuri yesterday. He said, we'll just lift inflation expectations. Central banks should embrace social media. They should communicate better, make it very clear what inflation expectations should be, and the problem's kind of solved. I think you can make a case for each of those perspectives, and I don't think there's a right answer. I see a few problems, though, with the try harder approach. Just keep on solving this problem with monetary stimulus. As I don't see the risk-return trade-off from that approach being particularly attractive. In terms of return, the effectiveness of monetary stimulus in driving up inflation, I think there's a question mark over how effective that is, and I can see clear side effects, and the side effects come on the financial side. If interest rates are low and the economy is growing quite well, that's a great environment to borrow to buy assets, and we've seen some of that. So we see higher debt and higher asset prices. It's helpful now, but eventually interest rates will hopefully need to correct, and some of those developments on the financial side will need to be reversed, and that's going to pose risks. So the effectiveness of more monetary stimulus to solve the lack of inflation is questionable, and I see clear risk from doing that. So I think that does leave us with the possibility of accepting that inflation might be just a bit lower than we'd like for a while. That's difficult for central banks to accept. So they see their job kind of deliver on the inflation target. But it's not so difficult to accept that if you see your job or your mandate as broader than just delivering on a specific rate of inflation. In Australia, our mandate was written back in 1959, and it hasn't changed since then. We haven't swung with the fashions in central banking. We don't have a single mandate. We don't even have a dual mandate. We have a triple mandate. That's price stability, full employment, and the general welfare of the Australian people. That's an unfashionable mandate, perhaps, in this room, but I'm really glad that we have that mandate, especially in the current environment, and I use all three elements of that mandate when I'm explaining what we're doing and why we're doing it. I often ask rhetorically, publicly, and to the politicians, do you think it would serve our collective welfare to have yet more monetary stimulus so that we could get back to inflation more quickly if the main way we got back to inflation more quickly was encouraging people to borrow more and push up asset prices even further? Now, not everyone's going to answer that question kind of the same way, but most people say, look, no, that's not worth it. Especially if the labour market's generating sufficient jobs, which is certainly the case. Last year we've had 3% employment growth. So in our case, my view has been that the welfare maximising approach, which is really what we're about, maximising the welfare of the people, is to be patient as long as the labour market is improving. As long as we're moving in the right direction, we don't need to force the process more quickly through monetary stimulus. One thing, though, that we have done in an effort to get there a bit more quickly is a version of option 3, lifting expectations. As I said yesterday, it's lifting wage expectations. My concern has been that a 2% wage norm has become the standard in Australia, and we're getting reasonable labour productivity growth. So 2% wage growth and reasonable labour productivity growth doesn't make for 2.5% inflation on a sustained basis. So I've been talking publicly quite a lot about trying to lift wage norms back to start with a 3 rather than a 2. Whether that works or not, I don't know, but I'd rather do that than try and deliver more monetary stimulus to get inflation rise. I'd rather do it by trying to lift wage expectations. Thanks, Stephanie.
Thank you. I can see everyone now preparing their resumes for applying to be the head of the Reserve Bank of Australia. It's a much nicer job. Governor Kuroda.
Thank you. Japan's economy has improved significantly over the past 5 years since the introduction of quantitative and qualitative monetary easing, or QQE, in April 2013. The economy is no longer in deflation, which is defined as a sustained decline in prices. However, wages and prices have continued to show relatively weak development compared with a strong economic expansion. The mechanism behind this phenomenon is not entirely clear. Today, I would like to talk about the recent experience in Japan, where the sluggishness in wages and prices seems to be more evident compared with other advanced economies, and discuss its implications for the Bank of Japan's monetary policy. First is firm's wage-setting stance. For the past few years, total cash earning per employee have been rising, albeit fluctuations. However, their pace of increase has been moderate compared to the labor market tightening, with the unemployment rate being at a record low level of 2.5%. In particular, base salaries of full-time employees, which account for almost of total employee income, have not risen much despite general labor market tightening. In Japan, lifetime employment has been widespread, and labor mobility across firms has been relatively low. Therefore, wages of full-time employees tend to reflect labor market conditions insufficiently, at least in the short run. In Japan, wage negotiations between labor and management take place at major firms every spring, where the rate of increase in base pay is decided. The rate has been almost 0% since around 2000 under the prolonged deflation. In 2014, when actual prices started to rise, there was a return to base pay increase for the first time in nearly 15 years. However, the problem is that the pace of increase in base pay still lacks strength. On this point, some have argued that reflecting that both labor and management in Japan place high priority on the stability of employment and wages, firms avoided large-scale layoffs and wage cuts during the prolonged deflation so that firms cannot simply switch to increasing wages even when the economy grows and the labor market conditions tighten. The deflationary mindset that had become entrenched among people has been quite tenacious, and it will take time to completely dispel this mindset. Second is firms' price-setting stance. Even though moderate wage increases have been taking place, wage costs have not yet been directly passed on to prices of products and services. Firms that face increases in wage costs will generally consider the following two options to maintain the same level of profitability. One is to pass on the increased wage costs to sales prices, and the other is to improve productivity through streamlining of business processes and labor-saving investment. So far, many firms in Japan have been making efforts to raise their productivity. The fundamental reason behind this is likely to be the tenacious deflationary mindset that I mentioned earlier. Consumers remain reluctant to accept price rises despite the improvement in the employment and income situation. Therefore, firms are cautious about raising prices due to their concern over losing customers. Another likely reason is that the productivity of Japanese firms, mainly in the service sector, is low by international standards, and thus there is significant room for improvement. In fact, initiatives are widely being taken in the services and retail sectors, such as enhancing efficiency of customer services, cutting back excessive services, and optimizing inventory management and delivery services. Such efforts by firms in these sectors are encouraged in part by digital technology in recent years, including artificial intelligence and robotics. These measures to improve productivity are expected to produce positive effects in the long run, in that they would address structural issues such as a decline in the working age population and lead to boosting the growth potential of Japan's economy. At least in the short run, however, they likely will reduce the upward pressure on prices. I would now like to make 3 points from the perspective of monetary policy. First, wages and prices have been improving gradually under the powerful monetary easing over the past 5 years, although sluggishness remains. A base pay increase has taken hold again in Japan's economy, and proportion of firms that have raised their base pay has been increasing steadily. In addition, mainly in the service sector, where there is an acute labor shortage, moves to reflect the increased wage costs in prices have been spreading gradually. as medium to long-term inflation expectations are projected to rise through the adaptive formation mechanism. If further price rises come to be observed widely, the Bank of Japan judges that the momentum toward achieving the price stability target of 2% is firmly maintained. Second, the bank therefore needs to maintain a positive output gap by persistently pursuing powerful monetary easing under the framework of QQE with yield curve control. The bank thereby will encourage firms' wage and price-setting stance to become more proactive and maintain positive momentum for a long time. Third, sluggishness in prices is attributable to a rising productivity that reflects technological innovation in recent years. It is important to continuously examine how this will affect the natural rate of interest as well as economic and financial activities. The effects of new technologies on the economy are often difficult to grasp in an accurate and timely manner using existing statistics. Thus, they should be examined in detail from various perspectives. Thank you.
Thank you. Thank you, Governor Kuroda. I mean, you've all focused on wages and wage growth, which is understandable given the challenges currently being faced. But I'm interested, Governor Kuroda, if I could just come back to you briefly, that Governor Lowe pointed out that even the 2% wage growth that they're seeing now in Australia was not enough to achieve the inflation target. How important is more wage inflation to you in hitting your target? What kind of wage inflation do you need to finally hit that Japanese inflation target?
The Japanese government has been asking labor and business to raise wages in the last 5 years. And this year, government even requested labor and business to agree to 3% wage increase during the so-called spring offensive. Final result is not yet known, but I presume total wage increase, including base pay, as well as other element of wages, would have risen close to 3%. As I said, the Bank of Japan is aiming at achieving 2% inflation target or price stability target, while the labor productivity increase in Japan is around 1%. That means that at least 3% wage increase is necessary to be consistent with 2% price stability target. So that the government request for 3% wage increase is quite appropriate. By the way, also the government has been raising minimum wages by 3% almost every year. And again, this is consistent with our price stability target.
I think, Governor Lowe, I'm interested in the context, the conversations that we had yesterday about whether or not central banks can really change people's expectations and the difficulty of talking to households and really changing their way of thinking when they're often really not wanting to pay attention to you at all. When you're trying to, I mean, how do you think about your capacity to affect that wage growth? You say that's a major focus now. You know, is it harder to do that because we're so concerned about talking to markets that we've become it's harder for us to talk directly to households, as I think Charles Whiplosh was saying yesterday?
Yeah, I'm not trying to talk directly to households on this particular issue. I'm trying to talk to businesses. We've got the situation where we've got the central bank governor calling for higher wage growth, the political leaders on a centre-right government calling for higher wage growth, and senior members of the business community calling for higher wage growth. Yet it doesn't happen. And then when I talk to individual businesses, they kind of agree in principle the country would be better off having wage growth of 3-point-something to 2-point-something. But not in their,
like being told what to do, though.
But not in their business. Yeah. And the reason that it shouldn't happen in their business is they're so worried about competition. If kind of we in a market economy we don't have the coordination mechanism to get to something which I think would be a better outcome, because no individual business wants to put up its wages more quickly than its competitors. There's a first mover problem. So the thing that I'm trying to do, and I don't know whether it's going to be effective, is to kind of help solve that coordination problem by saying, look, it's okay. It's okay to give wage increases of 3-point-something, and if that can become the norm, I think we'll be better off. And I don't know whether it's going to be effective or not.
I mean, President Draghi, I'm sort of interested. I mean, the Eurozone experience of this is a little bit different, and I guess not just because the recovery is not as far along as the many, many years recovery in Australia. You know, we've heard a lot in the last couple of days, and we just heard from Philip. There's something different about the wage bargaining process at the moment, and we're getting a lot of employment growth and not so much wage growth. And yet, if you look at the forecast for the Eurozone, it feels like we're not expecting such a transformation in the labour market outcomes, at least in many countries in the Eurozone. Maybe in some, we think the natural rate has fallen dramatically. You know, how do you think about whether or not wage bargaining and the wage-employment relationship has changed in the Eurozone?
Well, it's a difficult question because we actually have 19 countries, and each one of them has a historical setup of industrial relations, and I don't think they can be easily compared.
But you have to set monetary policy for all of them.
That's right, exactly. But and that's the challenge. But it's certainly changed in a sense. As I was mentioning, one of the reasons in the list of why is the wages aren't responding as fast as we were used to is the disappearance of trade unions. Now, in some countries, they were important to begin with, but in others were not. So there is a combination of factors that has changed this relation. But the point I was making before is that, yes, that's true, that explains the past. We are convinced that the future looks different, looks much more like we were used to see years ago when this relationship was stable, and we were looking at that to predict the movement in wages from the labor market conditions. So by and large, you have a variety of factors. We think, we are convinced they were very important in the past in explaining the slow speed of adjustment. And now they are sort of washing out, they're less important. We see, for example, that what was discussed in the first day of this conference, the residuals of our Phillips curve washing out, moving away. The relationship is increasingly capturing a rather traditional design. Now, of course, maybe we got to be careful here because maybe we want to see, absolutely want to see things that don't exist, and therefore we convince ourselves that they exist. But frankly, if I compare, for example, all the projections about future inflation that the ECB has produced over the last 4 or 5 years, you clearly see a greater convergence. You clearly see a narrowing down of the confidence intervals. You clearly see an upward trend in underlying inflation. For example, one thing that's telling is that over our projection horizon, the underlying inflation, now the core inflation, is higher than headline inflation. So in our projections, we're actually discounting some slowdown in oil prices, but an underlying strength which remains through 2020. So I'll say, yes, I mean, it's a complex continent, 19 countries, very different, lots of reasons. They can explain the past. Not sure that this diversity is what is the best predictor of the future. We've been
implicitly talking about as if we have hopefully many more years of recovery to go and to discover what the dynamics of wages and prices will be. But we started the week with quite a provocative speech from Larry Summers, who said that the world was now economically, politically and socially less prepared for the next downturn than it's ever been. Chairman Powell, do you agree with that?
Well, a couple of things we know are that interest rates have been lower, and we don't know this, but they will probably remain low, which means we'll be closer to the zero lower bound, which may mean that we're more likely to hit the zero lower bound. I think we've taken that into consideration. I think there's still fiscal policy space in the United States. There's less than there used to be. There's less than there should be. But there's some room to react, and I think we kind of take all of that on board. And the real question is, and I guess Larry may have said something about this. I didn't pick that part up, but what's the right policy response to that? And if you look at an economy in the case of the United States, which has growth well above trend, unemployment at 3.8%, inflation moving up, not quite at target, but getting close. And the federal funds rate still in a place that is accommodative in the view of members of the committee, perhaps 100 basis points below the median estimate of a neutral rate. So what that calls for in our thinking is continued gradual rate increases.
And I guess one of the things that came through in Larry Summers' remarks, but also in other places, is that because we know that there is this reduced monetary policy capacity, we expect there to be in the coming next time we have a downturn. The relationship between fiscal and monetary policy becomes quite a lot more complicated in this environment where you have a lot more unconventional policy or potential for unconventional policies. And I mean, even now, there's a potential for conflicts to develop between the fiscal objectives and the monetary objectives. I mean, Governor Kuroda, I wondered, how you think about the interaction between fiscal and monetary policy over the next few years in a somewhat abstract way, but is it now more complicated than when we first designed those independent central banks? And
always the cooperation between fiscal authority and central bank by way of policy coordination or something like that is necessary, but at the same time, the mandate of the central bank is basically the price stability and financial system stability. Of course, some central banks like the Federal Reserve and the Reserve Bank of Australia have another mandate of achieving full employment or something like that. But for the Bank of Japan, the mandate is basically price stability and financial stability. And we have to continue to aim at achieving and maintaining price stability and financial stability. And in some cases, that might make active, proactive fiscal policy somewhat difficult. But at this moment, I don't see any difficulty of coordinating fiscal policy and monetary policy arising in the near future. I don't see any problem.
Well, I guess one example is if the government is now going to move to having a broad target for the budget deficit, which includes the debt interest, then that complicates things for you a little bit.
The government is aiming at achieving primary surplus by fiscal 2025, and also trying to achieve debt GDP ratio to gradually decline over time. And I think that fiscal consolidation program is quite appropriate for the Japanese economy, as well as the public finance, because already the Japanese government has accumulated very large debt over the years, and it's quite necessary for the government to consolidate fiscal position, of course, gradually in the medium to long run. And that is not particularly inconsistent with our monetary policy in coming years.
I'm going to get on to, I can see these people thinking of their questions, which will be much tougher than mine, I'm sure. So I just had, but I had one more question for Chairman Powell. We had some discussion yesterday, I think you weren't here for it, but there was some discussion about how central banks should communicate to households and whether perhaps we end up talking a lot to financial markets means that you're also talking in a very careful, as you all are today, very careful way that then makes it harder for you to speak sort of directly and straightforwardly to households. You said in a panel that you participated in recently when we were both in Stockholm, you said you thought that maybe there would be less need for forward guidance in the future. I made me think when Charles Wyplos was saying you shouldn't be spoon-feeding the markets. Do you want to say a little bit more about how you see forward guidance?
Sure. So obviously we want the public and the markets to understand how we're thinking about the economy, how we're thinking about the path of policy, our reaction function, and that kind of thing. I think during the financial crisis, in order to support the economy, we began to do quite explicit date-based and then state-based forward guidance about the path of policy, and that was an unconventional tool that we came to rely upon. I think it worked. I think it did assure the public that rates would remain lower and that sort of thing. So as we move back to a more normal environment in the United States, we're going to have a shorter statement at the end of the meeting that won't have so much in the way of formal forward guidance. We're still going to have the summary of economic projections, which puts out quite a lot of information about the individual projections of individual members of the committee. So that's really how we're thinking about forward guidance, how I am anyway.
Okay. So maybe you'll take a group of questions from the audience, and then, yes, Ben Friedman. If we wait we'll have these two here.
Okay, Lars Svensson, Stockholm School of Economics. I have a question to Philip Lowe. He was nervous about the side effects of lowering the policy rate and raising inflation to the inflation target in Australia. Nervous about the side effects of that. I would like to point out to another side effect of undershooting your inflation target. If you do that on a sustained basis, if you accept lower inflation on average than your inflation target, that is like having an implicit, unofficial target below the official target. Once the market and the general public understands that, they will lower their inflation expectations. By the Fisher equation, that means that the average policy rate will then be correspondingly lower, and the gap to the effective lower bound will be shorter, smaller, and we will more likely hit the effective lower bound in the future. Doesn't that make the economy less resilient and more vulnerable? Isn't that a pretty important side effect of undershooting your inflation target?
Okay, I think we'll try and take a question from Ben Friedman as well, and then...
Ben Friedman from Harvard. My question is for any or all of our distinguished panelists. The overwhelming focus of discussion at this conference has been about how the flattening of the Phillips curve has made and is making it more difficult for our central banks to raise inflation up to their stated targets. I hope each of you has been thinking about the reverse of that proposition, which is that in the event, we hope unlikely, that something goes wrong and we wind up with inflation above our central.
Sorry, I'm late. क्या हुआ?
कुछ नहीं यार. Just working on my expansion plan.
Funding का चक्कर.
It is so frustrating. I feel like banging my head against the wall.
No, don't bang your head. Cross the bridge instead.
Bridge?
हाँ, ये देख. ला.
अरे.
This bridge gets you in touch with interested investors. Funding happens, which means more outlets, more customers.
Interesting. And what exactly is this bridge?
A stock exchange created for your kind of company. Just list on it and help your business expand.
Really?
Yeah.
तो फिर लिस्ट कर लूं?
और क्या? शुभ काम में देर किस बात की? चल.
हाँ.
NSE Emerge. साथ हमारा, सफलता आपकी. The SME Growth Platform from India's largest stock exchange.
One more opportunity to invest in ICICI Prudential Mutual Funds Bharat 22 ETF and own